Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the wealthyhomeowner.ca, Canada's authority on home ownership. Welcome back to the show, Ross.
Thanks for having me back on, Jim.
Ross, taxation, a big topic today as it applies to housing and home prices. A listener in Vancouver asked, can Ross comment on taxing the family home and if that would make housing more affordable? I mean, Vancouver, the residential property tax keeps going up 7 to 9% a year. How does that make housing more affordable?
Well, Vancouver does have the lowest the lowest household municipal income tax in the country. So let me state that one again, Jim. Vancouver has the lowest household income tax in the country. So we view municipal taxes like we do all tax. We don't care where the tax comes from. It's a simple tax. Tax should be measured on your income. That means if someone earns $100,000 and they have to pay they pay $6,000 a year in property taxes, municipal income tax in Windsor, and that same family only spends $1,500 in Vancouver, the family in Windsor who earns the exact same amount of money pays a higher tax rate. So that's how we see things. I'm not saying that's right or wrong. I'm saying we believe in apples to apples comparisons. Most of this discussion that's taken place, Jim, around taxes has to do with that little group out in Vancouver, which included the nutbag Paul Kershaw from Generation Squeeze, who's pontificated falsehoods now for, 5 or 6 years on people. Another academic who has no understanding, no research, no knowledge at all about this, citing his opinion. And opinions in themselves, Jim, are the reason why we are in the position that we're in today. The position we're in today is opinions versus data and math that can sustain a peer review. So when we have a 6-member expert panel out in British Columbia telling people that, if we raise transfer taxes, if we increase penalties, wait a second. What if we charge capital gains tax in the family home as solutions? We understand those people all have a bias or they have a stakeholder beneficial narrative that they want to get over. That means when you hear a realtor talking about a housing market, their narrative is one to generate commission earnings. If mortgage brokers talk about a housing market, the trade association, you have to understand that trade association is trying to book more mortgage debt through their brokers so their brokers can earn more money. If you have a housing advocate, affordability advocate, talking about housing, they are speaking solely from the perspective of trying to get housing for low income or people in need in their community. It's all biased. It's all opinion. None of it's altruistic. None of it is unbiased. It's all skewed to the narrative that they want to talk about, which is the same as municipal taxes. I personally, Jim, and this has only come into understanding about the last 3 years for us, see how the voters in Toronto vote in mayors who promise not to raise the property taxes in that city, while voters in my hometown, Burlington, vote in mayors who will raise the property taxes. They vote them in knowing the mayor is going to raise the property taxes so that the infrastructure is taken care of and so that there's no shortage in the community. That means the average $100,000 earning household in Burlington pays about $2,000 more a year in municipal income tax than the family in Toronto. Okay, that's a decision. Where the decision changes, though, Jim, is when those voters in Vancouver or Toronto then go to their provincial governments and say, hey, we got a shortfall. We gotta build some affordable housing. Our infrastructure's crumbling. We need some help. We can't fund this ourselves. And then the provincial government says, oh, we're going to go to all the other taxpayers in the province and we're going to ask them to kick in a little bit more so that the people in Toronto, homeowners, who voted in governments who promised to keep the taxes lower, don't have to see an increase in taxes. So not only in Burlington do you pay a higher share of your income to your property taxes than you do if you made the same income and lived in Toronto, but you also pay a higher provincial tax and a higher federal tax because the provinces go whining to the federal government about shortages, which eventually get filtered down to the voters in a community who vote to have the lowest property taxes possible. Look, the Federation of Municipalities are clueless to this. What happens if tomorrow the city of Burlington says, the voters say, no, we want to pay the same share of our income to property taxes that the citizens, the families in Toronto pay? Okay, that wouldn't make fair sense to me. It makes no sense that I can move to Toronto and because I pay lower property taxes there, I can buy a more expensive home, building wealth, more greater wealth over the next 25 years than if I stay in Burlington. It's totally unfair. The reason that unfairness exists, the reason that inequality exists in our society is because stakeholders and opinionated people who don't have the data, the math, to withstand a peer-reviewed analysis of their opinions are getting away with talking nonsense to the Canadian public, which politicians believe, then make decisions on, and enact policies which only broaden the inequality. Look, my personal opinion has changed radically over the last 7 years because my perspective has changed studying housing markets, and reviewing all the data that we have on home ownership. I personally believe that there should be a wealth tax in the nation and there should be no income tax. That's what I personally believe now. I would have to see the math and the data that would prove what my theory, that my theory is correct. But I personally believe, knowing the loopholes in the tax system and the way that the big wealthiest people in the country are taxed, that it would be better and more equitable if we had a wealth tax and zero income tax. Look, I saw something the other day that showed Warren Buffett down in the States. I think it was something from 2018, and he was worth, $24 billion or something at that time. Okay? Then they showed his income. Well, his income was like $230 million in a year. Then they showed his taxes. Well, he paid about 20% tax. Do you see the problem here? What you can do when you're wealthy is this. You can borrow money against one of your assets and have that money to live on. And as your assets grow, you just keep borrowing more money. In these low interest rate environments, it's even more attractive. That means since a taxation is happening right now on income, you're only taxed on what income you take. And when you borrow money from your company versus taking a wage, you're not taxed the same. It's a tax loophole. So when we talk about taxes, we have to talk about society at large. We can't just pick on homeowners that were lucky enough to be able to have a job where they bought a home in 1990. They paid ridiculous mortgage interest that a current home buyer at today's prices will never pay. They spend on average 2 to 3% a year upgrading their home to keep its place in the housing stock. They went through periods where the social safety net that we're under, they actually had to pay health insurance premiums every single month. I don't think most people understand. In the 1980s in Ontario, there was something called OHIP, and you had to pay for health insurance. The same income level today, you pay no health insurance in Ontario. So that's to make an apples to apples comparison, you have to look at those two things. When you hear someone talking about let's tax someone without looking at the whole picture, without discussing transforming the entire taxation infrastructure in your nation, you know they just have an opinion. They are not, their theories are not going to withstand a peer review. Because when you get the data, you do the math, you see the consequence, you see that it's not supportable. So, everything that you heard from this committee would be debunked in a peer review, meaning by us, with data and math that any economist, anyone, any child past the age of grade or past grade 5 with a calculator could say whether it was true or not. So housing will not become more affordable by taxing people. House price illusion, which creates housing unaffordability, is a consequence of an MLS house price pyramid scheme designed in the 1970s and 80s under a seller-exclusive agency representation model everywhere in North America. House price illusion through the MLS system is created to allow your local realtor to earn a commission, and then 13, 15, 20 years later, when they go back and see you again, they don't feel bad about the commission they paid you 13, 15, 20 years ago. And they're ready to pay you the commission again as a percentage of the home's value, the exact same thing, as they're trading up to their next home. Until you get this myth debunked, until your politicians step back and ask, how come every home seller in Canada can pay their real estate broker a bonus for getting them a higher price, but how come that not a single home buyer in Canada in history, well, except for one home buyer did, and then Royal LePage shut it down. Ironically, this Royal LePage agent, if you go to CBC News and you Google Karen Paul, you're going to see her story. Well, that is the real estate agent. Doesn't talk about her being a real estate agent. She was one of the top Royal LePage agents in the country at the time, who was forced to pay a buyer bonus, to the buyer rep, because the buyer rep negotiated a lower price on her listing. And Royal LePage couldn't handle that because it was going to destroy Royal LePage if that became the law. These are the myths that need to be debunked. When they're not debunked, opinions, bias, stakeholder involvement, false narratives control the conversation. The only thing that creates an opportunity for the truth to come out is when a housing bubble pops.
Ross, one of the questions asked for you was, former Bank of Canada economists are telling us that only rising interest rates would be the reason the housing bubble would pop. Does Ross agree with that thought, or are there other causes we can, quote, hope for?
Well, first of all, this clearly was not a former Bank of Canada governor called Mr. Dodge, because Mr. Dodge had to deal with the consequence of the last great housing bubble. I could sit down with Mr. Dodge, and in 15 minutes, he would be nodding his head up and down. I never knew that. I never knew that. You're right. You're right. You're right. Look, housing markets rely upon falling interest rates. We have said this several times on the show over the last few years. Housing markets rely on falling interest rates. That means you don't need rising rates. All you need is a stable rate. Now, once that stable rate is reached, it takes a certain given period of time for the housing bubble to pop. In Canada, that bubble was popping in the spring of 2020 when the nation was locked down. When the nation reemerged, local realtors claimed the housing market was going crazy. House prices were jumping year over year. They could show it in their statistics because that's what the MLS house price pyramid is designed to show. We are only now seeing a return of the market that what we are at in February of 2020. Look, folks, you are going to start hearing that year-over-year gains in sales were not as high in June as they were the previous month, and you're probably not going to hear any of the local realtors looking at it in comparison to what it was the first 4 months of the year. They're probably going to just focus on May, or they're going to say, oh, the market dropped in May, dropped in April, the market slowed down a little bit in May, and it slowed down a little bit again in June. That is not how a housing market functions, folks, because of the law of the multiplicity of sales. When a housing market is slowing down, it means months ago, first-time buyers were not entering the market in enough numbers to sustain the market as it existed then. Now, if what I'm saying is true, what would be the natural consequence of that? Well, that would mean fewer first-time buyers as a share of the total sales would drive the average price up, which is how you hit a national average record in April of 2021, because first-time buyers' share of sale was at a historical all-time low. That meant there are not enough buyers for the market to continue the way that it was in April, and sales would have to decline. Now, the way sales are reported, you're not going to really see it because they're comparing a year over year to last year, and they're going to say, oh, sales are still up 70%. Well, that's not how we read housing market. The reason why we can forecast so far in advance and why we don't worry about being wrong, the only thing we have to worry about is keeping the people who are trusting us to believe in what we're saying. That's all we have to do, because the market will prove what we're saying is true. Now, in this instance, we had a lockdown that caused a full year of housing market activity that had to be accounted for, because the consequences during that year, or the other variables that impact the housing market during that year, also impacted it. So that meant that when a wealthy homeowner sold their home in Vancouver and moved out to Abbotsford, the average price in Abbotsford jumped disproportionately when that single home sold, because there were no other sales in the sales chain that were needed. Same thing in Halifax. You also had new builders who moved their inventory to the MLS as soon as the lockdown hit, because they were worried about not being able to liquidate their inventory. Those new builders weren't counted in the sales the previous year, and since new builders, especially of single-detached homes, are always the highest-priced homes in the community, that drove the average price disproportionately again. And it would also cause extra sales in the total sales being reported by MLS systems to jump, which is exactly what happened. So when I say all these things, when I hear the nonsense about, rising interest rates, in other words, you have someone who cannot explain the basics of how a housing market functions, someone who is incapable of supplying you with the data and the math to sustain a common peer review, who is trying to give you a reason why they were wrong in the past. Anyone who believes that the housing bubble is any worse today than what it was in 2019 or 2017 or 2016, I don't know what you're smoking. The housing bubble is exactly the same. The housing bubble is no bigger. The concerns that we have today should have been in existence back in 2015. 2015 is the latest governments should have been acting to resolve this current situation. But governments believe opinions. Governments believe stakeholders. Governments believed biased viewpoints. Governments believe academics. Governments believe anybody who says anything that they think they can jump on without demanding proof. We've got $100,000 sitting out there. If you can prove house prices change in 31 days, there's $100,000 to be collected. If you say, you're just going to say it, okay, then put your proof online so that you can make us look like idiots. Go ahead. Publish it. Go in your Facebook groups, your chat groups, your Reddit groups. Go anywhere you want and discredit it. Go ahead and try. Eventually, we're going to see where your claims are made, and we will debunk you, because house prices don't change in 31 days. The only thing that changes is the sales mix. Rising interest rates are not needed to pop a housing bubble. We have been under a period of stable interest rates since the fall of 2017, because the OSFI instituted a mortgage qualification rate. That stabilized interest rates in a way they have never been stabilized in Canadian history. This little tiny change that happened June 1st is only a small, minor change. And it also happened at the perfect time. Where those other changes happened at the worst time, because Mr. Rudin, for all his goodness, doesn't understand how the trading cycle works. He did see that the banks were doing something very unethical, stretching gross debt service ratios to 39% for families when they historically had never done so, i.e. prior to 2016. So he had to act, lowering the gross debt service ratio, calling it the mortgage qualification rate. You don't need rising interest rate, folks. All you needed was Mr. Rudin back in 2017. First, stabilizing the interest rate for first-time buyers, and B, subsequently stabilizing the interest rate for trade-up buyers. In June, it just reinforced the stabilized rate that had already been in effect since 2017.
We'll have more with Ross Kay right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, a couple of weeks ago, you commented on inflation being a latent measure just like housing. Jennifer in Ancaster, Ontario asks, with house prices rising and inflation seemingly still in check, why does Ross feel we are going to be hit with higher cost of living numbers than economists have not even mentioned so far this year?
Well, Jennifer, just like house prices, in my opinion, now with the inflation factor, I have to say it's an opinion. I can't say that our theory on inflation would withstand a peer review. Someone would have to challenge us. We are not going to.
Well, Russ, back in the 90s, both the Canadian and U.S. governments agreed to remove fuel and housing prices from their official inflation index. So, yeah, it has been artificially manipulated, and your point of view probably is correct.
Again, I don't know, Jim. I mean, we deal with people. We deal with their incomes. We deal with their income after tax, and then we deal with their costs. So that's the perspective that we're looking at. We also are looking at the way that they're announcing housing. In other words, they're going to announce a house price in a few days for June that was really established in the first quarter of 2021. So this, as a sales chain exists in the spring of 2021, in the second quarter, the average price is going to reflect that old, latent structure of the home buying market, home trading market, not home sales, home trading. So when they're coming out with these numbers for June, we're already now into October and November. So we are already looking at that market, what that market is going. Now, we could be out a couple $1,000, but we're not going to be out tens of thousands. I mean, housing markets don't move that way. If you don't understand how the multiplicity of sales works and how that multiplicity of sales impacts the average selling price And the fact that everybody believes the average selling price measures the average home when it never has throughout history, then it's easy for you to sit back and make a forecast that you don't even have to worry about. Inflation's the same way, Jennifer. So inflation has been controlled to a certain degree by provinces that have rent controls. So what that means is you hear crazy things about rents in Ontario. One month you hear rents are up, next month you hear rents are down. But again, those reports are all generated from stakeholders who are simply seeking to drive eyes to their business model. So rent in Ontario is only changes for a very, very, very small share of all renters because there's rent control. So if you move houses, then yes, your rent could change. If you stay in your existing home, inflation is all the most that your rent could have increased. And last year, the government says no increase. So people didn't have to experience any increase. But the flip side of rent controls are they have been awesome from the day they were enacted through till today, because inflation first fell for over a long period of time, and then it remained extremely low. But now, the error in the design of rent controls itself is going to come back to haunt the Canadian public, because it's a self-inflating metric on the way up. In other words, if at the end of this year, the government was to come out and to say, the cost of living inflation was at 3.5% in 2021. That means all of the rents in the province of Ontario go up 3.5% the next year. In other words, you are already building inflation in the following year, because that's when that rate increase kicks in. But you're measuring that increase against the previous year. Again, from the day rent controls were put into place through till today, that has been okay, the way of the design of the rent control. It doesn't work the other way. But people are clueless to this. Governments are clueless. Now imagine your rental cost is included in your CPI. Let's say it hits 3.5% this year. Okay, that means next year, in January, for the sake of the argument, you already have a huge increase in inflation because rents are going to go up to 3.5%. And then the following year, inflation is going to rise again on this single component because of the design of the rent control. In other words, it's a self-inflating metric. So if you're not measuring the amount of self-inflation that's built into how they measure inflation, you're always going to be reading yesterday's news. No different than house prices. If you're not measuring, if you don't understand a claimed 3% house price illusion this month is going to return 3% house price illusion the following month, you can't forecast that house price illusion going. You're always going to be wrong. Luckily with housing markets, because the sales mix changes every month, and because the way that the trading cycle changes the rules that impact the housing market. Well, don't change the rules. The rules are as firm as concrete. Changes the factors that influence those rules in your mathematical equation. That inflation is controlled to a certain degree, but it's always there. It's always on the upward swing. It's the way that people trade homes. But think about it, folks. The vast majority, like 95% of Canadian families, move up the property ladder. People don't move down the property ladder until they're exiting a housing market. In other words, you're 80 years old, you decide that you don't want to cut the grass anymore, you physically can't cut the grass anymore, or you're widowed, and you're going to be alone, so you don't want to live in that big empty house anymore. You want to move into some place where there's a lot more community. Okay, now you're going to move to an exit home. You're exiting the housing market. Your exit is way quicker than your ascension up the property ladder, but it still happens. Which goes back to the discussion of how you control house prices. You know, it goes back to all the other discussions, but I don't want to get off topic. Inflation is a latent metric as far as we're concerned, the same way that house prices are. And for the reasons I just explained to you, except that a lot of the factors in the inflation are so self-inflationary that I think that's probably why a hyperinflation takes place. That's probably why. I'll have to look at the data over the next 10 years as we go through this period and do some calculations as we go along to try to understand this a little better. But I fully suspect that that's what the math is going to show. In other words, if oranges are going to cost me an extra 20% this year, I fully expect the cost of oranges to go up another 20% next year. Why? Well, because I know that there's a growing population with more demand on oranges and there's a limited supply. So unless they're growing the amount of oranges that are being grown, the number of they're putting in more orange trees to meet with that demand, prices are going to go up. No different than cars, no different than houses. It's all the same. There are certain metrics that are self-inflationary. Inflation itself is self-inflationary. And I explain that to you through rent controls. If at the end of this year, if you live in a rent-controlled province and the Bank of Canada announces inflation for 2021 was 3.5%, understand, during that entire year, your rent did not go up. So your rent was exactly the same in 2021 as it was in 2020. Because I'm going to use it in Ontario, the government said you can't raise rent. Okay. Now the rent controls are going to start working again. And the rent control says you can raise rents with whatever inflation was the previous year. Oh, rent's going to jump 3.5% next year. In other words, the base inflation rate for housing in 2022 is going to be a 3.5% inflation rate to start out with. That's how it works, folks. And then the following year, because we're already starting out at a 3.5% in January, maybe it's up to 5%. Okay, rent controls, the following year, rents go up 5%. We start out that January already at 5%. Now, to me, this is a simple self-inflating metric, which is why you have recession, which is why you have housing bubbles, which is why the regular Joe taxpayer is always disenfranchised sooner or later, and their families have to weather large periods of financial hardship, whether that be through low growth rate in their home's value, low income growth rate, or government pulling back the services that they provide their country. I don't know. I don't know what the outcome is. What I do know is that the MLS house price, average price, is self-inflating. Inflation, in terms of a housing component, is self-inflating. And if someone can supply the math to embarrass me and prove what I'm saying is wrong in terms of inflation, you can't do it with house prices because that's irrefutable. With the inflation metric, maybe you can say, Ross, well, you misunderstand something here. That's what you have to take into context. And the beautiful thing about inflation, though, folks, so let me leave today's show with this end. The beautiful thing about inflation is anyone who worked with homeowners from 1980 till 2004 in Ontario knows. Inflation removes a housing bubble with less pain. The inflation that we experienced between 1990 and 2004 wiped away about 20% of the housing bubble that existed in 1990. And the people don't feel that they lost that wealth. In other words, losing 20% through inflation is not the same as doesn't feel the same as losing 20% because your house price dropped 20%. We view it as exactly the same. One is identical to the other. Whether you lose it through a house price correction or you lose it through inflation, you still lost it. So when you're discussing inflation, we believe it's a latent metric. We already believe inflation is about 4% nationally. And I guess time will tell whether or not we're right.
Ross, thank you so much for chatting with us and have a great Canada Day.
Hey, same to you. Happy Canada Day to everybody who's listening.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross or the show, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter at House Street. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.